We've already met ERISA, the framework that governs how retirement plans protect workers' money. Now we turn the spotlight to how it operates in practice. ERISA, the Employee Retirement Income Security Act, was passed in 1974 to set consistent standards for private, employer-sponsored retirement plans. It doesn't require an employer to create a plan, but if one is offered, ERISA dictates how it must be run. At its heart are four key protections: participation, vesting, funding, and fiduciary responsibility. Participation means employees who meet certain age and service requirements, typically age 21 with at least 1 year of service, must be allowed to join the plan. Vesting defines when employees truly own their employer contributions. Employee contributions are always fully vested immediately. Employer contributions can follow a schedule, either cliff vesting, where ownership becomes 100% after a set period, say 3 years, or graded vesting, where ownership rises gradually each year until full. Funding requires that plan assets be kept separate from the employer's own operating funds, held in a trust for the exclusive benefit of participants. And fiduciary responsibility requires anyone managing those assets to act with the highest duty of care, the prudent expert rule. A fiduciary must act solely in the participant's interest, diversify investments, and avoid conflicts of interest. Self-dealing, such as using plan funds to benefit the employer, is a prohibited transaction under ERISA. When a violation does occur, penalties are severe, both financial and criminal, and fiduciaries can be personally liable. Another distinction ERISA enforces is between qualified and non-qualified plans. We've already touched on the broad difference. Qualified plans receive tax advantages because they meet ERISA's requirements. Non-qualified plans do not. But exam questions often go further. They'll ask you which type of plan requires non-discrimination testing, that's qualified plans, which type can favor executives, non-qualified, and how distributions are taxed. For a qualified plan, contributions are made with pre-tax dollars, growth is tax deferred, and withdrawals are fully taxable as ordinary income. For a non-qualified plan, contributions are after tax, growth is tax deferred, and only the earnings portion of a withdrawal is taxable. Among qualified plans, the common ones include 401ks, profit-sharing plans, money purchase plans, defined benefit pensions, and target benefit plans. All are subject to required minimum distributions beginning at age 73, unless the law changes again. ERISA also created the Department of Labor's Oversight Authority and the Pension Benefit Guaranty Corporation, or PBGC, which ensures defined benefit pensions. The PBGC steps in only for private sector defined benefit plans, not for defined contribution or public plans, and its coverage is limited. Let's bring in the tax-advantaged individual accounts that mirror those employer plans. A traditional IRA allows most adults with earned income to contribute up to the annual limit, currently $7,000 or $8,000 if age 50 or older. Contributions may be deductible depending on income and participation in an employer plan. All earnings grow tax-deferred, and withdrawals are fully taxable. Early withdrawals before age 59 and a half are penalized 10% unless the money is used for specific exceptions such as disability, first-time home purchase up to $10,000, certain education expenses, or substantially equal periodic payments. A Roth IRA uses after-tax contributions but allows tax-free withdrawals if two conditions are met. The account has been open at least 5 years, and the owner is 59 and a half or older. Roth IRAs also avoid required minimum distributions during the owner's lifetime, a significant advantage for long-term estate planning. By contrast, Roth 401k accounts inside employer plans follow similar tax treatment, but do require minimum distributions unless rolled into a Roth IRA after separation from service. Exam questions often compare contribution limits. Remember, 401k, 403b, and 457b plans share the same deferral ceiling, much higher than IRA limits. Simple IRAs and SEPs have their own formulas based on salary or percentage of income. A simple IRA allows employee deferrals and requires an employer match up to 3% of compensation or a flat 2% contribution for all eligible employees. A SEP IRA is funded only by the employer and can contribute up to 25% of an employee's compensation within an annual dollar cap. Self-employed individuals may use a KEO plan. technically a qualified plan for sole proprietors. The contribution and deduction rules mirror defined contribution plans, but they're reported differently for tax purposes. In addition to retirement plans, the exam expects familiarity with education and health savings accounts because they use similar tax incentives. A Coverdell Education Savings Account allows after-tax contributions that grow tax-free for qualified education expenses through college with a $2,000 annual contribution cap. A 529 plan, state-sponsored and much larger, also allows tax-free withdrawals for qualified education costs. These plans are considered municipal securities because they're issued at the state level, even though the funds may be invested in mutual fund-like portfolios. Finally, there's the Health Savings Account, or HSA, for individuals with high deductible health plans. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free, the triple tax advantage. After age 65, withdrawals for non-medical use are treated like IRA withdrawals, taxed as ordinary income but without penalty. As with every part of the Series 7, the key is comparison. Know who can contribute, how the money is taxed going in and coming out, what penalties apply for early use, and when distributions must begin. ERISA sets the rules of fairness and prudence. The tax code provides the incentives, and the investor's time horizon determines which mix of plans makes sense.